My article over the weekend was called What's Your Road, Man? Holy Boy Road, Madman Road, Rainbow Road, Guppy Road, any road. It's an anywhere road for anybody, anyhow. Where body how. Jack Kerouac's On the Road is an iconic novel and is considered a defining work of the post-war beat and counterculture generations, with its protagonists living life against a backdrop of jazz, poetry and drug use. When I reread these books, I cannot help feeling that the world has lost its wide-eyedness and innocence. I am also tempted to get myself an open-topped car and just take off and find out what exactly is going on. Jim Rogers, who was the co-founder of the Quantum Fund and Soros Fund Management, in fact did precisely that on a motorbike and called his book Investment Biker. Of course, it was George Soros and his subsequent partner Stanley Druckenmiller who forced the pound sterling out of the exchange rate mechanism on Black Wednesday, 16th of September 1992. I recall that day in slow motion and as if it were a newsreel. I was then on the trading floor at Credit Suisse First Boston, and the speed of thought and execution I witnessed that day, I never witnessed again, ever. Permit me the indulgence of dwelling on that day for a moment. At 10:30 a.m. on the 16th of September, the British government announced a rise in the base interest rate from an already high 10% to 12% to tempt speculators to buy pounds. Despite this and a promise later the same day to raise base rates again to 15%, dealers kept selling pounds. On my left was the proprietary trading desk, and he lent billions and billions of pounds at 15%. I asked, "What are you doing?" because the desk was at that moment the only desk in the entire city of London on that side. Everyone desperately was trying to hedge their books. He responded, "Ali Khan, it's not possible for mortgage rates to be at 15%. That was his insight, and that day he did not make as much as Soros, but must have been close. By the evening, Norman Lamont, the Chancellor, had capitulated, the pound was gone in a puff of smoke, and interest rates were back in single digits. Last week the pound had traded below 121, it's now 121.10, and is now in danger of taking out its post-referendum low 118.60, but there is considerable debate about this number because it happened in the middle of the night when gremlins and goblins stalk the FX markets. After which the only significant landmarks left would be the low set in 1985, a few months before finance ministers agreed on the Plaza Accord to limit the strength of the dollar, and then only a few cents lower, parity with the dollar. As I watched the pound fall like a stone, I could not help wondering if this sterling moment is precisely like it was in 1992, a no-brainer. Boris isn't bluffing. Every action, every appointment, every word since he entered number 10 signals the same thing. Britain is leaving the EU on the 31st of October, said the Telegraph's Daniel J. Hannan. The key question is this: can Prime Minister Johnson self-eject Britain? Can he be stopped? This is a political calculation. Prime Minister Johnson has elected to take quite properly an impossible is nothing and can-do political posture. But the bottom line is, can he swing it? If he can swing it, then he has to face down the whispering death, Michael Holding, who was thus nicknamed because he was exactly that, when he opened the bowling for the West Indies, that will be the foreign exchange markets. London's Capital Economics conducted an exercise for the dollar-sterling exchange rate and found that for every 10 percentage point increase in the chance of no deal equates to the pound losing 3.5 cents on the dollar. So if there really is still a 65% chance of no deal, sterling stands to drop an additional 22 cents or so. That's parity right there. We're currently experiencing the bow wave of what could metasize into a shock wave. The tariff war sanction and linguistic warfare specialist slapped a 10% tariff on the remaining $300 billion of Chinese imports. US 10-year Treasury yields sank below 190. This is obviously written on Sunday. The entire German yield curve went negative. The world's pile of negative debt jumped to more than $14 trillion for the first time ever. Emerging market currencies went into a tailspin. The market scooped up gold, the Swiss franc, and the yen. The most important currency to watch right now is the US dollar versus the yuan. And as I wrote over the weekend, we were at 697.38 on the offshore markets, and I said it could slice through 7 like a hot knife through butter. We are sitting in a vehicle whose wheels have fallen off, said Derek Matziak, a senior researcher at a South African think tank. The ISS told AFP about Zimbabwe, but that might well apply to the FX markets momentarily. President Trump keeps talking about weakening the dollar. I find it curious that such a stable genius is yet to calculate that a strong dollar is infinitely better. And if he is serious about his warfare strategy, he needs to add currency warfare to his tariff, sanction, and linguistic warfare arsenal. My perspective about the dollar is this, and note well, it's just a fraction under its 2019 high, even after a rate cut. There is very little President Trump can do. In fact, the risk is that when the market sees he is powerless, the dollar might lift off like the proverbial parabola. This is the Bank of England Sterling Trade Weighted Index via Sun Chartist. This is the Dollar Trade Weighted Major Currency Index via Sun Chartist as well. The 7 level was busted like a hot knife through butter, and this is what the Chinese authorities said. This 7 isn't like an age where once you've passed it, you can't go back, and it's not like a dam where if it breaks, water will flood through. So, plenty to mull over, and a very weak stock market at the same time, a lurch back into safe haven.